Good morning, all you cool cats and kittens. Welcome back. Tuesday, April 23rd. We are talking mutual funds and exchange traded funds, what they are, what the differences are, which one you should invest in, and why. Again, said it yesterday, probably one of the more important lessons of the trimester for you to pay attention to. When we're done with that, just a couple of slides to go through. When we're done with that, you have the Unit 2 review questions. You'll have today to work on this and tomorrow to work on this. Hopefully, you can get it done by Thursday. That will allow us to review ahead of our exam. We don't have school on Friday, so we got to get it done this week. Your tests on securities and investments will be next Monday, but I'll explain more about that when I'm back in the classroom on Thursday. We won't have time to invest this week because, again, we've lost today. So we'll move up to Wednesday, your week 6 payday and bills this week. Obviously, I'm looking at checking. Sorry, I'm looking at your budget sheet. I already did your checking account ledger last week. So let's get to it. By this point in time, I would imagine most of you, or some of you at least, your heads are absolutely swimming with, do I invest in securities? Do I invest in bonds? What company do I pick? Am I going to lose all of my money? I don't know what to do. I don't have time to study this stuff, read all this stuff. Fantastic. You're like just like 90 some percent of the American population. Then mutual funds are for you. Very similar to real estate investment trusts. A mutual fund is a bunch of people pool their money together, and they can do it at the beginning of the year, they can do it quarterly, they can do it monthly, or like most Americans, they're going to take a certain amount of money out of their paycheck and give it to an investment company, a brokerage company, and have them invest in it. Fidelity, Vanguard, Aspire, AXA, all of these things are more or less investment companies, and they all do mutual funds. These mutual funds are great because all you got to do is put your money in. Mutual funds come with a professional manager that will buy and sell different companies, different stocks, different bonds to make sure the value of the mutual fund increases. All right. I'm pretty sure it's like the Nerf Wars game that you guys are playing. You all chipped in money, and then some of you lost, and you chipped in more money to buy back in. And you're all trying to compete to win the pot at the end of the game. My assessment is you all will then divvy up the profits if you in fact win the game. This is exactly what a mutual fund is. You get a bunch of people, thousands, hundreds of thousands, perhaps even millions of people, all give their money to an investment company like Vanguard. There is a person from Vanguard that decides what to buy and what to sell. That person's job is investments. That person's job is to study the economy. That person's job is to know what is happening in the United States economy to generate the best rate of return for their investors. These people who are giving Vanguard or Voya or Fidelity their money to invest. If you have no time to study industry, the economy, the markets, then a mutual fund is for you. And again, most Americans do this. It is a great way to invest your money. When we started this unit, we talked about, one of the surest ways to minimize risk on top of researching and all of these other things, getting accurate information is diversity. The great thing about mutual funds is you could put as little as a couple of bucks in per paycheck, and you're going to have diverse investment. Look at the cost of Costco, 500-600 bucks, I think it was a couple of weeks ago. Unless you have 500 or 600 bucks, you're not buying Costco. And if you only had 500 or 600 bucks, you are only buying Costco. But a mutual fund, because everyone pools their money together, they have a huge nugget of money to spend. The person who is in charge, the professional manager of the mutual fund, is responsible for diversifying the investment to minimize risk for each of the investors. You will have jobs. careers, families, spouses, want a vacation, be tired, a home to keep up. You may not have time to follow the markets as closely as you should. Mutual funds are a great thing for you because your return from your mutual fund that you invest in, all right, is more or less based on how much money you put in. If the mutual fund only has $1,000 and you put in 100, your claim is 10%. So you get 10% of whatever the profits are. If the mutual fund, just for simple math, let's say is $1,000 and you put in $900, you get 90% of the mutual fund's profits. Mutual funds will be in bonds, they'll be in stocks, they'll be in small companies, large companies, they'll be in foreign companies, they'll be in domestic companies, they'll be in everything. A great way for you to invest your money. And here's the thing about mutual funds. There's literally a mutual fund. I can skip down to the bottom one. There's a mutual fund for every type of investor. Maybe you want to be in a tech mutual fund. Maybe you want to be in a pharmaceutical mutual fund. Maybe you want to be in retail mutual fund. There are mutual funds that are that specific. Perhaps you want to be in a growth mutual fund or a defensive mutual fund because, the economy is slipping. You can pick those things out and you can buy and sell out of a mutual fund anytime you want, just like a stock. All right. You don't want to be in the tech mutual fund anymore because something happened. You can withdraw. You can take out your money and your growth, your percentage of growth, and then take that money and go invest it somewhere else. There's even mutual funds that are set up for your retirement date. My retirement date is 2045. It's 21 more years. Jesus. Anyway, so the person who is in charge of my mutual fund knows that he's got 20 years left with this money. So you're going to take some risk because we've got 20 years to recoup from a loss. And as I get closer and closer, and the rest of the people in the mutual fund get closer and closer to 2045 retirement, you know that that person is going to start selling off stock and buying bonds to make sure our investments are safe. Mutual funds are a great way to invest money because they come with someone who knows what they're doing and they have skin in the game. They know how much they get paid every single year is determined by the profits, the growth of the mutual fund that they're managing. There is a downside to mutual funds, though. Nothing in life is free. If you're going to invest in real estate, if you're going to invest in mutual funds, you need to know that the person in charge of that mutual fund, the person who is buying and selling and making sure that you're making money, is going to get a cut of your profit. They're going to take a couple of percentage points. A couple of percentage points don't seem like very much, but a couple of percentage points over the course of 30, 40 years can be quite literally hundreds of thousands of dollars. If they're taking hundreds of thousands of dollars, that means you've made millions of dollars, but it does cost money. Similar to mutual funds, you have exchange traded funds, and it's more or less the exact same thing as a mutual fund, except it doesn't come with a manager. Your Voyas, your Vanguards, your Fidelities, just like mutual funds will buy and sell certain securities over the course of time. Your same companies, Voya, Vanguard, Fidelity, will group together companies, stocks, bonds, whatever it is, and it'll just be a package. Tech, retail, pharmaceutical, whatever you want. There are different exchange traded funds similar to mutual funds. You want aggressive growth, you want growth in income, you want small company, you want an index, right? You want to invest in all the S&P 500, you want to invest in all of the Dow Jones companies. You can buy an exchange traded fund. Your investment company, your brokerage has already bought those companies and put it together. And then what they'll do is they'll sell a certain number of portions of it to investors. Let's say they group Costco, Walmart, and Target together. They buy $1 million worth of shares of those three companies. Then what they'll do is they'll set a limit on how many people can buy it. How many people can buy a share of those three companies? We'll say 1,000 or 100,000, doesn't really matter. Once the portions are sold, once the pieces are sold, it's done. You own that forever until you sell it. The difficult thing about exchange traded funds is they don't come with a manager. Once those companies are set, once those securities are put together, there's no person buying or selling it anymore. It's your job. It's your job to decide when you leave that investment and how long you stay in that investment. It does not come with a manager to make sure that things are going correctly. It doesn't come with a manager who studies the market and knows that, whoop, Target's got a problem here. We should sell that. The benefit of an exchange traded fund, you get diversity with a very little amount of money. You can have target date set investments just like mutual funds, but it doesn't come with that manager. It can save you a lot of money because you don't have to pay. You don't have to pay anybody to manage that fund. Mr. Johnson is in exchange traded funds. He obviously follows the market very closely. If you have a limited amount of money going in, right? You're only putting in $100 a paycheck or $200 a paycheck or $500 a paycheck, still can't buy Costco. An exchange traded fund, just like a mutual fund, is a great way to get diversity, be diversified. Because it doesn't come with a professional investor, can save you money. You make $1 million, you get $1 million. I mean, you get it. You get all of it. You don't have to cut someone in on the profits. But that requires you to follow the markets pretty closely. That requires you to know what you're doing. And again, families, spouses, vacations, homes, you may not have time for that. So mutual funds and exchange traded funds, great things to invest in. If you don't know what to invest in, there's a pretty good chance that mutual funds or exchange traded funds will be a good thing for you. It'll be diversified. There'll be a fund. There'll be a group of investors geared with a similar goal in life, time frame. But the big difference is mutual funds come with a person who manages your money for you. Exchange traded funds do not. Mutual funds are more expensive. Exchange traded funds are less expensive. The difference in expense to you is how much time do you want to put in on your investments. Oh, I'm done. Unit 2 review, you'll start this today. You should have some time to finish it up tomorrow. Please make sure it's finished by Thursday when I'm back so we can have that entire day to review ahead of our test. This is probably one of our bigger tests of the trimester. So it's going to be an important one to do well on. Tomorrow you have your week 6 paycheck and bills. So until I see you tomorrow virtually, have a great day. Go Spartans.